Before we start this video, do like and subscribe to our channel and not miss on any updates.
Now we'll start with the third part of the consolidation, which is Accounting Standard 27, that deals with financial reporting of interest in joint ventures, right? Now, when we talk about joint ventures, we need to understand that what is joint venture and what are the types of joint venture that we generally come across. So whenever we say joint venture or JV in short forms, joint venture basically means, you are able to see the screen, right? Joint venture basically means there is some kind of joint. Now, when I say joint control, when I say control, we talk about holding and subsidiary. One entity controls the other entity. That is what is a control. But when we talk about joint control, two or more entities, they jointly control either an entity or an operation or asset. So for example, let us say, two of you or three of you friends, you decided to set up some kind of stall in one of the, let us say, some kind of fair or mela that keeps on happening. Okay, there what you thought, three of you will carry out an activity where you will get, let us say, some food items, you'll prepare the food items and you put up a stall there. That falls in the category of jointly controlled operations. You are controlling the operations without buying any asset together and without having a separate entity. Just three of you came up, you said, okay, one of you will buy, another one will prepare, third one will take care of selling. All three of you will carry out the operations, and finally you will share the profit. Now, when we talk about joint controlled operations, one important thing is there is no separate entity generally, no separate entity. And when I say joint control, all three of you should agree. All three of you should agree that yes, we'll do this thing or we'll not do this thing. So that is when we have a jointly controlled operation. Now, sometimes what happens is, out of three, let us say we are three of us, A, B, and C. A has 40% say, B also has 40% say, C has only 20% say. A has 40%, B has 40%, C has only 20% voting rights. And we need a special resolution to pass anything. Now, what is special resolution? Special resolution is 75%. Special resolution is 75%. Now, can A and C come together and take any decision? If A and C come together, you will have 40% and 20%, only 60%. So A and C coming together, you cannot have a separate decision. A and C cannot take any decision. B and C also cannot take decision. Who can take decision? Only A plus B. So we will say A and B are jointly controlling the operation or the entity. C is not required. Sir, so how will C account for it? 20% significant influence, they will account as per Accounting Standard 23. And A and B will account as per Accounting Standard 27. Okay, so that is what is a jointly controlled operation. So what is joint control asset? Say two of you decided to buy a car and run it, okay, and operate it. So that car which is jointly owned is called jointly controlled asset. So then what is jointly controlled entity? You come together and you start a new entity altogether. Okay, you come together and you start a new entity altogether. That is normally what we understand as joint venture. Okay, these are the three categories. Now, what is accounting? As far as jointly controlled operations are concerned, each venturer or operator, you can call it, accounts for its own transaction. Each venturer will account for its own transaction. They were not bothered about what the other party is doing. My part, what am I doing? That is what I will account for. Okay. So say for example, A and B, two of the parties, they came together for an operation. A carried out purchases of 10,000. B did the sales of 15,000. Now, if you prepare the P&L account of the joint venture, purchases 10,000, sales 15,000, you have profit of 5,000. Say for a moment, this profit has to be equally split, 2,500, 2,500. Now, how will A account for it? A would say, A will prepare something called as, you can have a joint venture account, or joint venture with B account, or B account, whatever name you call it. A would say, I have spent 10,000 for the joint venture. To bank, 10,000. Did I collect anything on behalf of joint venture? No. What should I get from the joint venture? 2,500 of profit. This profit I will credit to P&L, and because joint venture has to pay me, I would say to P&L 2,500. What will B do? In B's book, B will have their own JV account, JV with A. B has collected 15,000. So B would say, by bank, 15,000. How much is the profit share? 2 PNL, 2,500. Now here, he will receive 12,500. B will pay to bank 12,500, and like this the accounts gets tallied. Okay, that is when it is a jointly controlled operation. Now, what about, sir, jointly controlled asset? In jointly controlled asset, if you have purchased an asset with someone, let us say worth 5 lakhs, you will split into 2,50,000, 2,50,000. To the extent of your control, you will record in your respective books. Okay. The last one is joint venture. I'll come to that subsequently after we look at some questions on the JCO part. A joint venture is a contractual arrangement whereby two or more parties undertake an economic activity which is subject to joint control. So you have two or more parties, there is some economic activity, they have joint control, and there is an agreement. Joint control is a contractually agreed sharing of control over an economic activity. We said jointly controlled operation, asset and entity. Under jointly controlled operation, there is no separate entity. There is no separate entity. How will you do? Each venturer has their own business. There is no separate entity. All venturers are creating their own assets. I will buy my asset, you buy your asset. All of us will do like that. Each venturer will record only his own transaction without any separate set of books maintained for the joint venture business. So I will maintain my transaction. You maintain your transactions. Then we use our assets, we meet our liabilities ourselves, we only will make the settlement and all of that. Right. Finally, the income earned on the joint venture is shared as per the contractual agreement. Okay. Now, here if you see, Mr. A, B, and C entered into a joint venture to purchase a land, construct, and sell flats. Mr. A purchased land for 60 lakhs on 1st of January, and for the purpose, he took a loan from the bank at 8%, 50 lakhs. He also paid registering fees of 60,000 on the same day. B supplied the materials 4,50,000. He purchased material 5 lakhs for the joint venture. It's actually a jointly controlled operation. C met all other expenses of advertising, labor, and other expenses, which is 9 lakhs. On 30th June, each of the venturer agreed to take away one flat, each to be valued at 10 lakhs, and rest were sold as follows. Mr. A sold 40 lakhs, B sold for 20 lakhs, C for 10 lakhs. Loan was repaid on the same day by Mr. A along with interest, and net proceeds were shared equally. Now, when you have this type of question, first thing that you have to do is you have to prepare draft P&L account. You don't call it consolidated. It's not the right way. You will say draft joint venture P&L account. Draft P&L account means what? For all the venturers, all the expenses, all the income, as if you are preparing the P&L account of the operation. It is draft. It is not maintained by anybody. It is not maintained in any of the books. So that is what you will do. First thing. Okay. Now, once you have done that, what will you do? All the expenses you will debit, all the income you will credit. Expenses like land purchase, registration fees paid, materials incurred, any other expenses, interest that is paid, interest on loan. So that is your expenses. Okay. So who purchased the land? Mr. A. He paid, you'll make a breakup. Then sale. Whatever is individually sold, you will take it, and they have agreed to take one flat each at 10 lakhs. So that also you will credit to P&L, because taking away is also like sale only. Once you do all of that, you get the profit. Total sale minus total of all these expenses, you get profit of 18 lakh. This will be shared equally by each of the partners. Okay. This is prepared on a rough sheet or a draft basis. Then what will happen? A will maintain joint venture account. When I say A is maintaining joint venture account, what A will do is any expenses that A has incurred on behalf of the joint venture, you will debit to the joint venture. Any income you have collected on behalf of the joint venture, you will credit to the joint venture. So, for example, purchase of land, 50 lakhs. It is in the books of A. Now, A has taken loan, and A has purchased the land. Okay. Now, A will not say land account to bank. You will not do. Instead of land, you will say joint venture account debit, because I have purchased it for the joint venture, to bank. We have taken loan of 50 lakhs and we have paid through bank 10 lakhs. That is what we will do. So 50 plus 10, that is debited. Then Registration fees paid 60,000, bank interest paid 2 lakhs. These are all the expenses. What is the income that you will credit? Means you have already collected on behalf of the joint venture. So sale of flat, building taken over. This is what you will do. And you have to receive profit of 630 from the chief. So profit will be posted this side, loss will be posted on the credit side. Balancing number you will receive from other parties. How much will receive? Immediately, no need to plot it. You prepare same way joint venture account of B and joint venture account of C. Whatever is the balancing figure, they have paid of 470 and 1420. 470 and 1420, the balances will add. Simple when it comes to jointly controlled operation. Now, when it comes to jointly controlled asset, again, no entity, common control. Venturer shows only their share of asset and total income earned by them along with the total expense incurred by them. So, whatever is their share, that is what they will show. Whatever is their share, that is what they will show in terms of asset. If at all there is any share of income or expenses, then whatever is their share of income and their share of expenses, that is what they will record in their books. A Limited, B Limited, and C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. For the purpose, following expenditure was incurred. Buildings 12 lakhs at 5 to be depreciated at 5%, pipeline 60 lakhs at 15%, computers 33 lakhs at 40%, various vehicles 9 lakhs at 20%. They also decided to equally bear the total expenditure incurred on the maintenance of the pipeline, that is 6 lakhs. You are required to show the consolidated balance sheet and the extract of statement of P&L and the balance sheet of each venture. The first thing is this is not a consolidated balance sheet. We don't have a terminology like consolidated balance sheet. They're constructing a pipeline. To transport the gas. So we are creating an asset. Okay. Now, how we will work out is because we have incurred, now for example, here we have incurred 12 lakhs of cost and depreciation should be at 5%. So as far as the asset is concerned, 12 lakhs minus 5%, if I do, I get 11 lakh 40,000. This is the joint controlled asset. This joint controlled asset will be shared by A, B, and C in their respective financial statement. Same way, plant and machinery, each party will separately own. Each party will separately own. Vehicles also, each party will separately own. Separately own means for the purpose of the books of accounts, we will show it separately. For the purpose of the books of accounts, we will show it separately. So, what did A Limited record? A Limited in the P&L will record their depreciation expense of all these assets and pipeline is 6 lakhs is the cost and they have decided equally to bear the expenses. So 2 lakhs of expenses will be borne by who? Will be borne by A Limited. Same way in the balance sheet they will show the non-property plant and equipment 23 lakhs 80,000 based on land share, land and building. So because it is building, it is being depreciated. Plant and machinery, computers, vehicles. So what is basically happening? Each party is taking their share of asset and accordingly they are charging their share of depreciation in their books. Right? Okay. Then this 2 lakhs of expenses, that is their share of expenses. That is what they are recording in their books. Now, if you compare this with jointly controlled operation, in jointly controlled operation, you did not show expenses and all separately like this in the books. You just said, I have a joint venture for joint venture, I have incurred so much of expenses. For joint venture, I have earned so much of income. Net amount what I have to receive, that is what you maintain. Whereas when it comes to JCA, what is your asset share? What is your income share? What is your expenses share? All of that you will record in your respective books. Same way we will do. Same way we will do. It is nothing complicated. It is simply that we are splitting the asset between each of the parties. The most important part is the jointly controlled entities. Now, when we have jointly controlled entities, what you have to understand is if at all there is a question on jointly controlled entity, treat it as consolidation question with some percentage consolidation. For example, let us say 50% consolidation. Means what? How do we do it? Whenever we did consolidation, holding and subsidiary, we took 100% of assets, 100% of liabilities. But when it comes to jointly controlled entities, we will take only 50% of asset, that is our share. So what we will do, whatever is our share in the joint venture, our share, we will pick it up and we'll add it to our assets. Same way, liabilities, 50%. We will also calculate goodwill or capital reserve and show that in the balance sheet like we do for subsidiary. But assets addition, liabilities addition will be only to the extent of our share, and there is no minority interest. We don't have any minority interest when it is a jointly controlled entity. That is the only difference between a subsidiary and a jointly controlled entity accounting. Then when it comes to P&L, in P&L also you will take your share of profit, income, expenses. In case, for example, when we had the subsidiary thing, we took 100% of profit. But here you will take only your income, your expenses, your profit share. A Limited, a UK-based company, entered into a joint venture with B Limited in India, wherein B Limited will import the goods manufactured by A Limited on account of joint venture and sell them in India. They agreed to share expenses and revenues in the ratio of 5:4, whereas profits are distributed equally. A Limited invested 49% of capital, but has equal share in all assets and is equally liable for all the liabilities of the joint venture. Following is the trial balance of joint venture. Now, what they are saying here, when they're saying they have entered into a joint venture and they have contributed 49% of capital, but they have equal share in assets and equal share in all the liabilities, which means what? It is a joint venture, and then you have to split the assets, liabilities accordingly and incorporate that in the books. Purchase is given, expense, sales, PP, current assets, unsecured loan, current liabilities, capital is given. You are required to prepare the consolidated financial statements. Okay. Now, again, this in true sense is not a consolidated financial statement. They are basically preparing the financial statement of the joint venture. We are preparing financial statement of the joint venture, the separate entity. Now, for the separate entity, what is the sales? 13,05,000. 13,05,000. What is the expenses? 9 lakhs and 3,06,000. 9 lakhs and 3,06,000. Then closing inventory is 1 lakh. Opening inventory was 0. So closing inventory is higher. Show as a negative expense number. So your profit is 1,99,000. In the balance sheet, they have agreed to share 49% and 51%. That is how you have to split. Now, how will we split that? So they have not given the number. So we'll do a back working of that. Okay. As far as purchases, expenses and all are concerned, how will the split be? Split will be based on they have equal share in assets and equal share in all the liabilities of the joint venture, whereas A Limited and B Limited agreed to share the expenses and revenues in the ratio of 5:4 respectively. So what we will do, if there is an expense of 9 lakhs, this you will split as 5 lakhs for A and 4 lakhs for B. 5 lakhs for A, 4 lakhs for B. Same way other expense, purchase and all of that, he will do the split. So purchases 5 and 4, sales 5:4. Expenses 5:4, all of that 5:4, but closing inventory, this is equal, right? Then reserves and surplus, profits are distributed equally. Typically, this does not happen in real life. Okay, it is very difficult to say that expenses and revenues you will share in the ratio of 5:4, whereas profits will be distributed equally. That doesn't work. But because they have given in this question, we'll do it that way. Profit is to be distributed equally. What is the profit? 1,99,000. So profit of 1,99,000 is distributed equally. Liabilities distributed equally, long-term borrowings distributed equally, property, plant and equipment equally, inventories equally, other current assets equally. Now this equity share capital that you get is the balancing number. It is the balancing number. This balancing number, you will give 49% to A and 51% to B. Okay, that is how you will solve in the question. So here you will have in the share capital, the balancing number 49 to A and balance to B. Now this is important. After this, I will also share with you one combined question including A, B, and C. It's holding subsidiary and all of that. Please have a look at it once. That is one thing that you need to practice. Okay. A Limited entered into a joint venture with B Limited on 1:1 basis, and a new company C Limited was formed for the same purpose. And the following is a balance sheet of all the three companies: 10 lakhs, share capital, reserves, loans, current liabilities, PP, JV, current assets. So this is investment in JV. This is the JV. Okay, this is very important when it comes to examination. Prepare the balance sheet of A and B under proportionate consolidation method. I will do for A Limited. For B Limited, you can practice it for your own. Okay. Now, when I say proportionate consolidation of A Limited, it is A Limited plus JV C Limited. How much? Our share. How much? Our share. Now, how to compute? You will do as if you are doing consolidation. So first, you will calculate goodwill or capital reserve, if any. Okay. Then, what is the share? 1:1. So you will take 50%, not share capital, 50% of your assets, loans, current liabilities, property, plant and equipment, and current assets. That you will add to A Limited. That you will add to A Limited. Okay. And whatever is the post-acquisition share in the reserves and all of that, that also you will add. So how we will do is, first we'll calculate goodwill or capital. Here, I don't think there is any goodwill or capital reserve, but let us say share capital, 10 lakhs, reserves, loans, all of that is given. So, how much is the investment? Investment is 2,50,000. Investment is 2,50,000. What is the share capital? 5 lakhs. What is the share capital? 5 lakhs. What is the share in net asset? Share in net asset is share in share capital, 2,50,000. And this entire reserves and surplus is post. So we'll not consider that. So only thing that we'll consider is 2,50,000. 2,50,000 is share in net asset. 2,50,000 is investment. Is there goodwill? No goodwill. Is there capital reserve? No capital reserve. Okay. Then how do we prepare consolidated balance sheet of A? You will take share capital of A. You will take only share capital of A. In reserves and surplus, you will take A fully, and you will take 50% of 12 lakhs, which is 6 lakhs. So 18 plus 6, 24. Non-current liabilities, loan, 3 lakhs plus 1 lakh, 4. Current liabilities, 4 lakhs plus 50,000, 4 lakh 50,000. Property, plant and equipment, 30 lakh 50 plus 50% of this number. And current assets, 2 lakhs of this plus 50% of this number, you get the total. Sir, what if there was goodwill? For example, just for argument's sake, share capital is formed at, it is at 5 lakhs. We invested 3 lakhs. Investment is 3 lakhs. But share capital, for whatever reasons, our share is only 2,50,000 net asset. So this becomes 50,000. So how is it possible that in a new company we invest 3 lakhs but only get 2,50,000 of share? I'm not talking about a new company. I'm talking about an existing company. I've invested in an existing company of 3 lakhs. Net asset is only 2,50,000. So the value is how much? 50,000. Or I have agreed with the other venturer that I will give you 3 lakhs, but my share capital, what I will get is only 2,50,000. There can be multiple arrangements. Okay. So this comes out to how much? 50,000 of goodwill. So what you will do? From investment, you will remove 3 lakhs. You will remove 3 lakhs and the net asset automatically will get knocked off there. Balance 50,000 you will show under non-current asset as intangible asset, 50,000 goodwill, like you do in the case of subsidiary. For this, I'll be sharing one link in the group. I'll also add the solution in the your courses. You can get access from that, so that you can go through it. Good question. You should practice it because it may come in the examination or it may come as a part of MCQs. While preparing notes, own company C Limited 50% share you have to prepare it. B Limited you can do it for Kumba. Okay, then you have intercompany transactions. Intercompany transactions as in transaction between the holding company and the joint venture, that also you will eliminate accordingly. Any questions? Any questions as far as joint venture is concerned? Okay, so one thing in the examination, what you should do is not be scared. When I'm saying not being scared is, a lot of time what happens is the questions are framed in a way, or lengthy questions are given way which causes us concern. How to solve, how to solve. Don't be scared because of that. Okay, so now we'll do one combined question. One more combined question. What I told is I'll share it as a link. You can have a look at it. It's a very good question. Okay, that gives you a lot of clarity, and it's not a very long question. It's not a very long question. Give you a good amount of clarity. Now let us have a look at this one. On 1st of February, this is as per September 24 paper, where they have not asked the combined thing, but they have asked the calculations. On 1st of February 24, Best Limited acquired 80% equity shares capital of Cool Limited for 1480. So Best has acquired Cool. This becomes a subsidiary. On 31st March of 24, end of the year, Best acquired 25% of equity shares of Good Limited for 380. So this becomes an associate. The following are the balances extracted from the books of Best Limited, Cool Limited, and Good Limited on 31st March of 24. Equity shares of 100 each, fully paid 30, 20, 10. Securities premium 2,20,000. 9% debentures 630 and 240. General reserve 269, 84, 120. All these numbers are given. P&L balance, investment, PPE, current assets, trade payable, including bills payable, sales, raw material consumed, wages, and production expenses. P&L account of Cool Limited showed a credit balance of 30,000 on 1st of April 23. When did we acquire? We acquired on 1st of February of 24. When did this happen? This balance they have given on 1st of April of 23. Now, why did they give as on 1st of April of 23? So that you can calculate profit for the year. You can calculate profit for the year, and when you calculate profit for the year, you can split it between pre and post. Acquisition happened on which date? 1st of February. So you have 10 months of pre, 2 months of post. General reserve balance is brought forward from the previous year. So it is the same number continuing. So general reserve is same number. P&L, we have a different balance on 30,000. So basically 30 became 270. So we can say 2,40,000 is post acquisition. For the year, out of 240, for 10 months, that is 2 lakhs is pre-acquisition, 40,000 is post acquisition. Okay, then investments 1750, 610. Then adjustment we are looking at. On 31st March, all bills payable in Cool Limited balance sheet were acceptance in favor of Best Limited. However, on the date, Best Limited held only 3 lakhs of these acceptance, rest having been endorsed. What is the meaning of this? Cool Limited balance sheet. Who is Cool? Cool is subsidiary. Bills payable. All bills payable. They're saying all bills payable were in favor of Best, but Best had only 30,000 in hand. 3 lakhs in hand. Means Best in its current asset has bills receivable from Cool Limited to the extent of 3 lakhs. Where is balance? Balance is with the creditor or bank, what they have said, it is gone to the bank. So for intercompany adjustment, only 3 lakhs is relevant. Best Limited had purchased goods costing 5 lakhs from Cool Limited on 1st of June of 23. Now, please understand, this purchase happened before the acquisition. This purchase happened before the acquisition. If the purchase happened before the acquisition, we will not adjust in the revenues because this is pre-acquisition. But on the date of acquisition, entire goods remain unsold at the end of the financial year. On the date of acquisition, Best purchased goods costing 5 lakhs from Cool. So Best purchased from Cool. Whereas on the date of acquisition, these goods are not yet sold. Towards the end also, these goods have not yet been sold. Best Limited is preparing consolidated financial statements for 31st March of 24. You are required to calculate trade payable, consolidated current asset, and all of those things. Now, what is trade payable consolidated? Trade payable consolidated is only trade payable of 380 plus 4,10,000. Associate you will not consider. And if it was a joint venture, you will consider only to the extent of percentage. I am repeating once again. Best, you will take 100%. Cool, you will take 100%. Good, you will not take anything because here you will follow equity method. So 380 plus 410 minus 3 lakhs. 380 plus 410 minus 3 lakhs, 4 lakh 90,000. Simple, 1 mark as it is. You will. Okay. Then current assets consolidated. What do we do here? Current asset consolidated is 965 plus 560. 965 plus 560 minus 3 lakhs because that is held as bills receivable. Then inventory is there. See, transaction happened before, but when we are consolidating, we'll take the cost only. When we are consolidating, we'll take the cost only. So that adjustment also needs to be done. Best, cool, minus intercompany ownings minus unrealized profit. How much is unrealized profit? Goods costing 5 lakhs at 650. So unrealized profit is 1,50,000. This unrealized profit has to be eliminated. So you will eliminate the unrealized profit from the stock. You will eliminate unrealized profit from the stock and show the net amount in consolidated. Sir, do we eliminate the minority share and all of that? See, this is 150. This 150 is profit lying in stock. In consolidated balance sheet, we show 100% stock. So 100% will be eliminated from the inventory. Then next is minority interest. Now, as far as minority interest is concerned, how much did they acquire? They acquired 80%. So when we say minority interest, for quicker calculation, equity shares 20 lakhs of this 20%, securities premium of this 20%, general reserve of this 20%, 2,70,000 of this 20%. Directly you can do. Sir, are we required to do analysis of profit pre and post? If you want to do pre and post analysis, that also can be done. Okay, if you want to do directly, that also can be done. Because as far as minority interest is concerned, all of these they are entitled to at 20% subject to adjustment. Subject to adjustments. Okay, then share capital, securities premium, general reserve, profit and loss balance, and all of that. Now, one thing that you have to understand is, though the transaction happened before, when we are consolidating the entity, what did we say? There is unrealized profit on inventory 1,50,000, which we have to eliminate. Who sold this? Subsidiary sold to holding. When subsidiary sells to holding company, if I am eliminating the profit, I have to eliminate from the profit of subsidiary. So if I'm eliminating from profit of subsidiary, minority interest also is there. So what we will do, we'll reduce that unrealized profit stock of 20%. So if I'm taking P&L balance fully, minus unrealized profit, 1,20,000. Of this, 20% is their share, 24,000. This is the adjustment. You get the closing balance of minor. Okay. Then goodwill capital reserve on the acquisition of Pool Limited's share. Goodwill capital reserve on acquisition of Pool Limited share. Now, if you look at Pool Limited share, the acquired cost of investment is 14,80,000. Cost of investment is 14,80,000, and rest all we have to do the normal calculation. Okay. Balance is 30,000 opening balance. So purchase consideration 14,80,000 we know. Then we have share of in the share capital 80% of our net asset. Securities premium in our net asset, general reserve net asset, opening balance 30,000. That is also pre-acquisition. Then 270 is a closing balance minus 30,000 was opening balance. We earned 240 during the period. Who earned? Subsidiary earned 240 during the period. This 240 you will divide between 10 months and 2 months. You will divide between 10 months and 2 months. 10 months will become 2 lakhs. Of this 2 lakhs, our share is 80%, so 1,60,000. Our share is 80%, so 1,60,000. Or if this is slightly confusing for you, you can do your normal analysis of profit, where you will take pre-acquisition 30,000, the opening balance of 30,000 as it is goes in pre-acquisition. Then for the year profit is 2,40,000. This 2,40,000 pre is 2 lakhs. Post is 40,000. So what you will do? 30 plus 2 lakhs. 2,30,000 is pre. This multiplied by 80%. So 2,30,000 into 80%, you get 1,84,000, which is nothing but 1,60,000 here and 24 here. So you can do it in the normal tabular format that we have been doing. That is also possible. Then there is profit stock, which is now coming back to the entity, which is unrealized. 1,20,000, this you will remove. So it is down to 40. It's down to 40 because 120 is the unrealized profit. The subsidiary sold to the holding company, but sir, it sold before. We know it sold before, but when we are consolidating, that profit is not yet realized by the group. If the profit was realized by the group, no need of this adjustment. Because the profit is not realized by the group, we will do this adjustment. Okay. Then you get the capital reserve number. Please practice this once in the format that you have been using for the normal, problems. Then for good limited, goodwill or capital reserve on the acquisition of good limited, very simple. Investment made 380. What is our share on date of acquisition? We acquired on 31st of March. So as on 31st of March, 10 lakhs. This is debenture. General reserve 1,20,000, P&L balance 50. So 10 lakhs plus 120 plus 50. 10 lakhs plus 120 plus 50. Of this, 25% difference is goodwill. Profit and loss account consolidated. You will take 100% of profit and loss of the holding plus the post acquisition share in the subsidiary minus any adjustment that has happened. Now, please understand here, when we are doing the consolidated P&L, inventory adjustment you will not do here. So why not here? Because we have not done that on the date of acquisition. We have done that on the date of acquisition. So directly you will take best limited balance and 80% of post acquisition of Cool Limited, 32,000. Okay. Then general reserve consolidated, 100% of the general reserve consolidated, 100% here. This 84 will not take because this is pre-acquisition. We'll take only post-acquisition. Revenue from operations. Now, when it comes to revenue from operations, please understand, we will take sales of this plus this and will not do intercompany adjustment because that happened before acquisition. So 56 plus 38 directly we will take 56 plus 38 for 2 months, not for full year. Okay. Then cost of raw material consumed, same thing you'll take for 2 months. 14 marks question. Even if you goofed up in 1 or 2 adjustments, this was a question where 10 marks would have been scored easily. Are we comfortable with this, or is there any doubt? Any specific question you have in this? All clear? Okay, great.